Warren Buffett, often hailed as the Oracle of Omaha, is known for his ironclad investing rules that have guided him to become one of the wealthiest and most respected investors in history. His principles are simple yet profound. Invest in businesses you understand, avoid unnecessary risk, hold for the long term, and most importantly, stick to your circle of competence. For decades, Buffett has famously avoided tech stocks, speculative bets, and companies outside his grasp. But recently, something unprecedented happened. He broke one of his own cardinal rules, and Wall Street is reacting with unease. This move by Buffett isn't just another headline about a billionaire making a new bet. It shakes the very foundation of what many investors have come to trust as a blueprint for successful investing. When Buffett shifts, the financial world pays attention, and when he breaks a rule he's followed for over half a century, nerves naturally set in. So what exactly did he do? Why did he decide to break with tradition now? And what does this mean for the markets, for individual investors, and for the future of his empire? Understanding this requires looking deeper into Buffett's history. He built Berkshire Hathaway from a struggling textile company into a colossal holding conglomerate by making disciplined choices. His portfolio was a fortress of blue-chip companies, banks, insurance firms, and consumer brands, companies with strong fundamentals, durable competitive advantages, and predictable earnings. For years, Buffett preached patience and prudence, emphasizing that it's better to buy a wonderful company at a fair price than a fair company at a wonderful price. Then came the shift. The move that defied his well-established playbook wasn't a hasty gamble but a carefully calculated decision. It involved entering a sector or buying a stock that Buffett traditionally avoided, perhaps something more speculative or outside his circle of competence. This decision raised eyebrows because it appeared to contrast with the risk-averse, value-driven philosophy he championed. Investors and analysts began to speculate. Is Buffett signaling a new era of market dynamics? Could this mean traditional value investing is losing ground to newer, faster-moving sectors like technology or alternative investments? Or is Buffett simply adapting to changes in the global economy, recognizing that the landscape has evolved in ways that require fresh thinking? These questions aren't trivial. They strike at the heart of how investment strategies are formulated and how individuals should approach their portfolios. One way to understand the significance of Buffett's move is to consider the broader context of the current economic environment. Interest rates, inflation, geopolitical tensions, and rapid technological advancement have all contributed to a market that feels less predictable than in the past. For someone like Buffett, who built his fortune on stability and clarity, breaking a rule suggests a calculated response to complexity rather than a reckless departure. Moreover, it's important to realize that Buffett's rules are not rigid laws but guiding principles. Even the most disciplined investors must occasionally adapt. The question then becomes, how do you know when it's time to break your own rules? What criteria justify taking a step outside the comfort zone? Buffett's move offers a case study in balancing tradition with innovation, caution with opportunity. Throughout this discussion, it's clear that Buffett's reputation amplifies the impact of his actions. When he speaks or acts, markets react not just because of the money behind him, but because of the wisdom and trust he's cultivated. Breaking a personal rule sends a strong message. Either the rule itself needs reconsideration, or the circumstances are exceptional enough to warrant an exception. Either way, it's a moment that challenges assumptions and invites reflection. Now, let's pause for a moment. If you're finding this topic intriguing and want to stay updated with deep dives into investment insights like this, make sure to subscribe to the channel. Your engagement helps us bring more quality content that helps you navigate complex financial landscapes. Also, drop a comment sharing what you think about Buffett's recent move. Do you believe he's making a smart strategic pivot? Or is he risking too much by breaking his long-held rules? Your thoughts might spark a fascinating discussion, and we love hearing from you. Returning to the analysis, it's vital to break down what this means practically for everyday investors. Buffett's approach has long been admired for its simplicity and effectiveness. Many individuals have modeled their strategies on his principles, focusing on fundamental analysis, margin of safety, and patience. When Buffett breaks a rule, Does this mean those principles are no longer reliable? Not necessarily. Instead, it highlights that investing is not a one-size-fits-all game. Markets evolve, and so must investors. It also underscores the importance of context. A rule that worked flawlessly in one economic era might need adjustment as new factors emerge. For example, the rise of technology has altered business models, competition, and growth trajectories in ways that traditional metrics sometimes fail to capture. Buffett's break with his rule might be seen as an endorsement of adapting frameworks to reality rather than clinging dogmatically to past doctrines. It's a reminder that flexibility and critical thinking are essential traits for investors, even legendary ones. For those who have followed Buffett faithfully, this development encourages reevaluation and deeper understanding rather than blind imitation. It's also interesting to consider the psychological and leadership aspects of this move. Buffett has long been a symbol of stability and consistency. By publicly breaking his rule, he demonstrates humility and openness to change, qualities that often go unappreciated in high-profile leaders. This can be empowering for individual investors who may feel pressured to be perfect or rigid in their strategies. Looking ahead, what might this mean for Berkshire Hathaway's future? Will this shift lead to new investment areas, or is it a one-off strategic play? Will Buffett's successors carry forward this more flexible approach, or will they revert to stricter adherence to traditional rules? These are critical questions as the company prepares for generational leadership changes. At the same time, Wall Street's nervousness reflects deeper market concerns. Buffett's break with his rule might be interpreted as a warning sign or a hint of underlying volatility. Investors often look to figures like Buffett for reassurance, so any deviation from the norm can trigger uncertainty and sell-offs. However, it might also be an opportunity for savvy investors to reassess their own portfolios and strategies in light of changing conditions. To wrap this up, the story of Warren Buffett breaking his own investing rule is far more than a simple headline. It encapsulates the dynamic nature of investing, the need for adaptability, and the balance between discipline and innovation. It's a powerful lesson that even the most successful investors must evolve to stay relevant and successful in shifting markets. If you want to dig deeper into investment strategies that balance tradition and innovation, make sure to check out our next video where we explore how modern investors are blending Buffett's timeless wisdom with new-age financial technologies. If you thought this was surprising, wait until you see how AI is changing the way portfolios are managed. Don't forget to like and subscribe so you don't miss out. Your journey